Hi, thanks for joining us today. My name is Brad Williamson. I'm the chairman of the Employee Benefits and Executive Compensation Group here at Latham and Watkins, and I'm joined today by my partner in Chicago, Robin Struve.
Welcome, Brad, to Chicago. Thanks for braving the cold.
Thanks for having me. Robin and I will be talking about a very important recent court decision that came out at the end of last year that involves private equity funds and underfunded pension liabilities. The case is called Sun Capital Partners versus the New England Teamsters Pension Fund, and it's important because it gets to the question of when can a private equity fund be liable for underfunded pension liabilities at a portfolio company. So Robin, when could a separate entity like a private equity fund ever be held liable for a portfolio company's pension liabilities?
The Sun Capital case is very good because it has a long history. The principles behind it are governed by ERISA, and under ERISA, there's a concept called control group, and the control groups involve any entities or trades or businesses that are 80% or more under common control. So first you have to have a trade or business in order to be subject to ERISA liability, and second of all, you have to own 80% or more of an entity or another trade or business that has the pension liability.
And so the implication is if you have one entity that is a trade or business that's under common control with another entity, then if there is underfunded pension plan liability or multi-employer plan liability at the first entity, even if the second entity is not a plan sponsor or doesn't otherwise contribute to the plan, they can be liable for the same liabilities as the first entity.
Yes, there's joint and several liability under ERISA. And in the Sun Capital case, it's very important because the portfolio company went bankrupt. So it was the primary obligor under the pension fund. So the pension fund came after the deep pockets of the private equity firm in trying to recoup its losses on underfunded pensions. In the Sun Capital case, as I said, has a long history. At first, the district court found that the question at hand was whether or not the private equity could be a trade or business.
Right, because before that case, most people thought private equity funds would not be trades or business, or should not be considered.
Or should not be trades or businesses because they aren't, all they are engaged in is the investment of capital.
Right.
In 2012, Sun Capital appealed that district court case up to the First Circuit, and the First Circuit found that, in fact, the Sun Capital funds were engaged in a trade or business. On remand, the district court then found that they had formed a partnership in fact, or a per se partnership, and therefore could be deemed owning 100% of the portfolio company. Although in the Sun Capital case, the two funds owned 70-30 in fact. That creation of a partnership in fact was important and was the subject of the second First Circuit decision, which came out in November of 2019. And in that decision, the First Circuit found that a partnership in fact had not been created, and therefore the private equity firms were not liable for the underfunded pension.
And what factors did the First Circuit look at when determining that the two funds did not create a partnership in fact, and what lessons can private equity funds learn from that?
So the First Circuit, in its 2019 decision, looked to tax court precedent and looked at several factors it considered to be both for and against creating a partnership in fact. Some of the factors it considered to be against being a partner, creating a partnership, were specifically that the agreement that the funds entered into in forming the acquisition vehicle said it was not intended to form a partnership in fact. And then, although they had overlapping investors, the funds had separate investors, they had kept separate books and records, and they filed separate tax returns. So those were all important facts that the court found. Facts that the court found to be indicative that they may have formed a partnership in fact were that both private equity firms were essentially controlled by the same two people who served as the investment committee for both entities, and that they had common purposes and they had common operations together, in that they both were due diligencing the companies together and making investment decisions together.
The types of lessons that our private equity fund clients could take away from this is the importance of keeping separate books and records, the importance of filing separate tax returns and the like, the importance of corporate formalities, and if you form a separate investment vehicle, to make sure that there is language specifically stating that you're not intending to create a partnership between two separate funds. If the funds want to go even further, they could think about things, although I don't think it's necessarily required under the logic of the decision, but things like have separate individuals serve on the board in order to take another step away from, any implication of a partnership.
Yes.
In fact,
have each partnership or each fund designate a director, or
Right,
each fund.
right.
And oftentimes you may have to do that for other purposes. And generally, I think most funds would keep separate books and records because they have separate investments.
right.
Where you might have an overlay or not such good record keeping sometimes is with parallel funds.
And I think it's worth noting that I think under the logic of the case, it does seem that if you have true parallel funds that invest in the same businesses, either in the same proportion or even in different proportions, that the court may look at that more carefully, and it might be more likely to find a partnership, in fact, than a situation like we had in Sun Capital where they were not parallel funds.
Right. I mean, a parallel fund may have different investors, but otherwise, they are oftentimes just lockstep together. I'm not saying it will end up in a partnership, in fact, but it would be more likely to create that. I don't think the First Circuit's case has, put an end to those claims of partnership in facts, and so you do need to be careful about it.
Because at the end of the day, whether there is a partnership in fact is a facts and circumstances analysis. So it's hard to have any bright line comfort that you are or are not a partnership in fact when it's always evaluated on the individual facts of a case.
Yes, exactly. Similar to being a trade or business.
Yeah. Right. So Robin, as always, it was great chatting with you today. Thanks so much.
Thank you, Brad. It's always nice to see you too.
And thank you all for joining us today.